What's up, everybody? This is Sunko, the Korean bro. Today is 2023, July 28th. And let's see, okay? First, Malifo.com. Okay, three stocks should be glad you bought at these prices. The market's raising a glass to these two soaring stocks. Three green flags for Palo Alto Networks future. Hmm. Um. Okay. Let's see. IBM first is on my list is IBM. Okay. Novo Nordics, and we got Target. Okay. First, let's see this. The market's been relentlessly bullish. Like with the S&P 500 up hefty 20% just since its recent low in mid March. Every time it seems like another new 52-week high for the index just isn't possible. The market surprises us. The big rally has driven lots of companies back to extremely pricey valuations. Of course, it's easy to doubt there's much more near-term upside left for many of these stocks. Hmm. There's no denying that international business machines, it better as IBM, isn't what it used to be. Big Blue used to be the powerhouse of the tech sector. Then software became more important than hardware. After that, competitors figured out how to succeed in the shrinking hardware business. Then cloud computing and mobile took center stage. These were all evolutions in the marketplace that IBM wasn't quite ready for. If you think it's a lost cause, though, think again. Leveraging its 2019 acquisition of Red Hat and following 2021 spin-off of its managed infrastructure business, IBM is fully repositioned as a cloud services and software operation. Artificial intelligence and cybersecurity are also in its wheelhouse. Immediately, it's still only a shell of its former self. Double-digit percentage revenue growth isn't in the cards for it anytime soon. If ever, its business model is increasingly a subscription-based one that trades off big growth for a consistent and predictable top line. Indeed, more than half of its revenue is now recurring revenue driven by subscriptions to its software and services. The new approach is working though. Its second quarter operating cash flow of $2.6 billion was twice that of the prior year quarter, extending what has turned into a healthy growth streak. IBM maintains that it's on course to generate $10.5 billion worth of free cash flow for the year versus 2022's $9.3 billion, thanks to a shifting business model that promotes recurring sales of software. You can step into this stock now while it's priced at less than 16 times next year's projected earnings. But better than that, you can dive in while it's sustainable, well funded. A dividend yield is more than 4.7% at the stock's current price. One rarely find yields that big within the tech sector. Hmm. Okay, here's Roku. Hmm. Shares of Roku were up almost 20% Friday morning. The connected TV streaming specialist reported second quarter financial results that showed how hard it's working on restoring its former growth trajectory. Roku's numbers gave shareholders hope for the future. Revenue climbed 11% year over year to $847 million, roughly equal contribution to top line growth from both the platform and device segments. Despite declines in gross margin, Roku effectively kept its operating expenses under control. Roku still lost money, but even though the losses were more extensive than in the year ago period, they were much improved from levels 3 and 6 months ago. Viewership metrics continued to work in Roku's favor. The company had 73.5 million active accounts, up 10.4 million over the past 12 months. Viewers streamed a total of 25.1 billion hours of content, up 21% year over year. And although revenue per user was down 7%, that wasn't enough to take away all of Roku's sales gains. Roku expects current trends to remain in place. With macroeconomic concerns weighing on consumer demand to some extent, however, investors seem confident with Roku's long-term story. As traditional cable TV gives way to the streaming video experience, Roku is concentrating all of its efforts on. Now, three green flags for Apollo Auto Network's future. Okay, I myself also invested money into Palo Alto Networks, and it's a positive at this point. The main reason I bought a share of Palo Alto Network is because as time goes on, the importance of cybersecurity uh, will go up, and also as the time goes on, the more people will be using IT devices, and the more people will be using software, which means at the same time, the importance of security goes up because you know once all of your information is gone, it's too late, right? So before that happens, you have to be prepared. Hmm. And the best way to do so is to use software that prevents that from happening. And for that situation, the best solution that you can get is by using the software uh, like Palo Alto Networks provide. No, Palo Alto Networks. Let's see. Oh, okay. Palo Alto Networks. The company is profitable and sales are growing quickly. The stock's valuation has risen recently, but for good reasons. The cybersecurity industry should expand for many more years. Investors could hardly be more optimistic about Palo Alto Networks stock right now. The company is exposed to several potentially game-changing niches, including artificial intelligence, cybersecurity, and software as a service selling. Its encouraging growth results through early 2023 suggests that these factors might help it post market-beating sales gains even as it elevates profit margins over the next several years. Back in black. With that potential in mind, let's take a closer look at the core reason that Wall Street is so excited about this growth stock today. Okay, before fiscal 2022, it had been 4 years since Palo Alto Networks had achieved a full year of positive profits. Investors will be happy to hear that the company is determined to keep its young earnings streak alive. An intense focus on reducing costs has allowed operating income to rise to $134 million over the first 9 months of fiscal 2023, compared with a $200 million loss in a year earlier. Success has bolstered management's goal of maintaining annual profitability far into the future. It also gives the company more flexibility when it chooses to invest in high return growth initiatives like artificial intelligence. In other words, there are many ways in which investors can benefit from Palo Alto Network's new features of sustainable profitability. Growing the base is usually a good sign when a management team upgrades sales and earnings outlook, and that's especially true during choppy economic times like these. Palo Alto in late May said it now expects to boost billings by as much as 25% this fiscal year, up from the prior target of between 22% and 23%. The earnings picture brightened even more. Robust demand for cybersecurity services in a tight spending environment has earnings on track to reach between $4.25 and $4.29 per share, up from the previous forecast of between $3 and $4. The business is becoming more efficient as it grows and as sales tilt more toward higher contract values from larger enterprises. That's one reason investors are hoping to see further sales and earnings upgrades when Palo Alto announces its fiscal quarter four results in late August. The price is right. Okay, given the stock 70% plus rise through late July, you might think the best invest returns have already come and gone with the stock, but Palo Alto Network doesn't seem prohibitively expensive right now. Sure, it's a price sales ratio of about 12 seems high, compared with the PS ratio of around 8 from earlier in the year. But the valuation is on par with what investors are seeing in other parts of the high growth tech world, including Microsoft. Microsoft shares would deliver much higher profitability, cash flow, and a more diversified sales footprint if you're interested in buying a software specialist with more focus on cybersecurity, though, and with a bright long term outlook on growth and earnings improvements, then you should consider adding Palo Alto Networks to your watch list. Okay, three no-brainer stocks I buy right now without hesitation. Okay, will really Palantir Software. New Holdings has been unchanged face of. Okay, let's see. Palantir. The Palantir is a no-brainer pick because no other company matches its capabilities. It not only interprets data, but also makes recommendations based on its analysis. It has also utilized AI in this process to make its system smarter, and recently introduced its artificial intelligence platform, a generative AI platform to process data from large language models. Hmm. And recently introduced its artificial intelligence platform, a generative AI platform to process data from large language models. Entities appear to consider this analysis valuable. In the case of its commercial product, the Foundry increasing numbers of customers willing to spend $100,000 per month to subscribe to the platform. Despite the significant expansion, the customer count rose 41% year over in the first quarter. Wow, 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 wow. Yeah. There it goes. Entities appear to consider this analysis valuable. In the case of its commercial product Foundry, increasing numbers of customers willing to spend $100,000 per month to subscribe to the platform, despite the significant expense. The customer count rose 41% year over year in the first quarter. That helped total revenue grow 18% during that time to $525 million. Also, quarter first was its second quarter of positive net income under generally accepted accounting principle, which came in at $90 million. And Palantir forecasts GAAP earnings will be positive in every quarter this year. Consequently, Palantir stock is up more than 150% this year, and while a 17 price sales ratio may seem high, investors should remember that the sales multiple was consistently above 24 during the 2021 bull market when the company was losing money. That indicates that the stock's run is far from over. Now we have Zscaler. Okay. Okay, here we have a really important information that mm, customers customers of Palantir has been using the product that they provide uh, continuously, and even there are more consumers who are willing to pay for more, which is a good thing. And this percentage is interesting. The customer count rose 41% year over year in the first quarter, mm, which uh, signifies that the service they provide is worth the money, right? Otherwise, they would have not, spent the money in first place. Mm. And now we have Zscaler. Okay. Cybersecurity stocks like Zscaler continues to benefit as an increasing number of cloud customers move to secure their networks. Zscaler has stood out by leading the way in zero trust security. Zero trust assumes every potential network entrant is a threat and will verify authenticity by factors such as company rank and location. It may also grant partial access depending on company rank, limiting the damage of any potential breach. Consequently, Zscaler had more than 2,400 customers spending over $100,000 into fiscal third quarter. Hmm. A 29% increase in 1 year. Also, okay, that's important information. Also, dollar-based net retention rose by over 125%, meaning long-term customers increased spending on the platform by over 25% over last year's levels. Meaning long-term customers increased spending on the platform by over 25% over last year's levels. Even those figures, it should surprise few that fiscal quarter third revenue grew 46% year over year to $490 million. And while it lost to $46 million during the quarter, it reduced losses from the $101 million reported 1 year prior to that report. That indicates that continued revenue increase should bring eventual profitability, and the forecast revenue of nearly $1.6 billion for fiscal 2023 will amount to 46% annual growth if the forecast holds. Mm. Okay, Zscaler stock gained nearly 40% so far this year. While some investors may see the 15 PS ratios as high, it is not far above historical lows, a factor that should bode well for new and current shareholders alike. Mm. Okay, now we have CrowdStrike. CrowdStrike Holdings. Okay, the annual damage inflicted by cyber criminals are projected to reach $13.8 trillion by 2028. CrowdStrike was one of the first companies to incorporate artificial intelligence into its cybersecurity software. CrowdStrike is one of the fastest growing software companies in history. Its stock currently trades at a healthy discount to its historical valuation. The rising cost of cybercrime should be a tailwind for this artificial intelligence growth stock. The S&P 500 has reversed course and ripped 18% higher this year, as investor sentiment has improved in response to signals of economic resilience and enthusiasm surrounding artificial intelligence. The Leasing index is just 5% from a record high, meaning stocks have nearly clawed their way back to bull market territory. Cybersecurity companies CrowdStrike sure to benefit from that trend. Here's what investors should know. Cybercrime is an expensive problem. Okay, digital transformation is driving the proliferation of connected devices and corporate software systems across private data centers and public clouds, creating new attack surfaces for hackers. But cybercriminals are also becoming more sophisticated in their attack techniques as they evolve away from traditional malware. Relying instead of difficult to detect malware for attacks such as abusing valid credentials. The problem is made more serious by industry-wide labor shortages. The global cybersecurity workforce increased 11% to 4.7 million people last year, but the number of unfilled positions increased 26% to 3.4 million. That means many organizations lack the skills needed to adequately protect their sensitive data and devices, and demand for skilled workers is outstripping supply. Hmm. Okay. Hmm. Many organizations lack the skills needed to adequately protect their sensitive data and devices. Okay. You know, um, a lot of business will have to have a lot of IT devices, right? And as more IT devices are connected, mm, at the same time, there's gonna be also a lot of threats, uh, and mm, hackers will use a sophisticated technique mm, to attack a vulnerable system. So, uh, to prevent that from happening, uh, cybersecurity installation is important. Mm. But uh, lack of force, lack of labor force, uh, but because of a lack of labor force, it's not gonna be easy for corporate or businesses to prevent that attack from happening. Of course, if lucky, um, one would get away with it, but then it's important that they or you prevent that from happening at first place, because once that happens, there's no way to, mm, you know, get back. So anyway, so that means many organizations lack the skills needed to adequately protect their sensitive data and devices, and demand for skilled workers is outstripping supply. In total, the cost of cybercrime is expected to increase at 12% annually to reach $13.8 trillion by 2028, according to Statista. Suffice to say, cybercrime is a serious problem, and that tailwind should translate into a strong demand for cybersecurity software in the years ahead. Okay, CrowdStrike was one of the first companies to apply artificial intelligence to cybersecurity, and management says its unmatched ability to crowdsource data makes its AI engine uniquely effective in identifying threats. Consultancy Frost Surveillance came to a similar conclusion in a recent report. CrowdStrike leads the industry with regards to the application of artificial intelligence and machine learning to endpoint security, as well as providing unparalleled prevention of malware and malware-free attacks. But Spur AI is just one of the many innovations CrowdStrike has brought to cybersecurity. It also invented a new approach for stopping breaches known as indicators of attacks, a technique that analyzes behavioral patterns to proactively identify threats rather than relying on reactive indicators of compromise like other vendors. The combination of Spur AI and the IOA-based detection allows CrowdStrike to prevent sophisticated malware-free attacks and zero-day exploits that legacy solutions cannot detect. Now, surprisingly, CrowdStrike has received a great many commendations from industry experts, spotlighting the breadth and utility of its cybersecurity platform. Forrest Research, Gartner, and the IDC have recognized the company as a leader in managed detection and response and endpoint security. Similarly, First Surveillance has recognized leadership in threat intelligence, cloud-native application protection. CrowdStrike is one of the fastest growing software companies. Okay. CrowdStrike crossed $2 billion in annual revenue last year, becoming the second fastest software company in history to reach their milestone. Some of that momentum has dissipated amid the challenging economic environment, but CrowdStrike still reported solid financial results in the first quarter. Revenue increased 42% to $693 million, and non-GAAP net income soared 84% to $0.57 per diluted share. Investors have good reason to believe CrowdStrike can maintain or even extend its market presence in the years ahead. The company has a material advantage in its knack for innovation, a quality that allows it to promptly address new threats as they appear across the ever-evolving cybersecurity landscape. CrowdStrike has introduced a slate of new products in the last year alone. Uh, Falcon Shellfish is an external attack surface management module that helps business close security gaps across their IT ecosystems. External attack surface management module that helps business close security gaps across their IT ecosystems. Hmm. Helping them cope with the cybersecurity labor shortages. Currently, CrowdStrike estimates addressable market is $76 billion, but management says its product pipeline could push this figure to $158 billion by 2026. Its shares currently trade at 14.5 times sales, not a cheap valuation, but still a bargain compared to the 3-year average of 33.7 times sales. With that in mind, risk tolerant investors should buy a small position in this AI growth stock right now. Last but not least, I'm going to read an article about Upstart Holdings. Okay, Upstart Holdings. The fintech company that uses AI to assess borrowers and help financial institutions make lending decisions. It's out to challenge a fair Zal's FICO score that currently dominates the market. The stock has been eroded since its December 2020 initial public offering. The company's IPOs at $20 increased over 780% by October 2021, shed over 95% of its value by the end of 2022, and is now up close to 390% in 2023 as of July 26. Borrowers approved had 53% fewer defaults than borrowers from large US banks at the same approval rate. Home loans could add another 2.7 trillion TM. Investors should take comfort knowing that company early stages of what could be possible. The downside to Opera is its volatility, but that's to be expected of a growth stock of its size. Interested investors dollar cost averaging their way into a stake to avoid investing a lump sum before a sudden drop. Okay, I briefly read a couple of articles because I felt like it. This is it for today, and I'm gonna see you tomorrow. Okay, bye bye.